Great. Well, thanks. And just a shout out, I know we've got a few of the Camino Geo team here. So when I talk a little bit of geology, they will squirm like they normally do with my simplistic engineering geology. And prior to Camino, was part of the team that started Centennial in Denver and in the Delaware. And I see my partner in crime, Brett Sitman, is on the call today. So it's great to see Brett, and we had a good run there. So much appreciated. So what I thought I'd talk about real quick is probably a third of the presentation, so 10 minutes, on kind of Camino and what we do in Oklahoma and the Delaware as well, and then really get into the meat of it, of really what's hitting our industry today, right? And there's just a different meteor, it seems like, hits our industry every day. So it's both exciting and a little scary, everything that's going on. So real quick, who is Camino? So obviously Denver-based. We've also got a large office in Oklahoma City. And we're backed by private equity in GP and some co-investors. So we've become the largest private company in the SCOOP stack merge. We really don't have any stack. We're in the merge and the SCOOP, and I'll kind of describe the differences here in a quick minute. But we've drilled about 70 wells, produced about 43,000 BOE a day, mixture of oil, gas, and NGLs, and pretty big footprint with the acreage and then the inventory that comes with that. One of the key things that allowed us to survive 2020 was our balance sheet. We've got very minimal debt, and we're just hedged to the hilt. So we were hedged all during 2020, and kind of in the high 50s oil. So we were able to ride that out, and then we're currently hedged the same way this year. So that keeps things moderated. We're not necessarily getting the great upside of higher prices, but don't get the low side of lower oil prices. So that's one way we've survived all this, to be pretty conservative when it comes to our balance sheet and how we hedge things. We kind of back in the nadir at the bottom there in April, we went down to 0 rigs. We were running 1 to 2 really before that, but then we brought one back real quick in June. So we've been running a rig ever since, which has been great. And then we're also going to add a second rig here in April in Oklahoma. We didn't really have to shut anything in during the low oil prices. One good thing about being in Oklahoma is you're very close to Cushing, so the differentials are low and your netbacks are high. So that's great. You see a little red on the map on the right. We're also a large owner of a midstream business that collects all of our gas, and that's just kind of the simplistic pipeline outline of that. And I'll focus here on the next couple of pages here back onto the blue lines there of what sets up the core in the SCOOP stack play and what is not. So moving on, a little bit of a quick geology. Can't do a talk to RMAG without a little bit of geology. And again, it's pretty simplistic from the engineering point of view. Because I think a quick thing about Oklahoma with the SCOOP stack and the merge is we're our own worst enemy in having way too many acronyms and making it sound like they're all different. And to me, really, SCOOP stack merge, it's the same source rock, which is the Woodford, and it's the same targets, which is both in the Woodford and then this lower Mississippian section on top of it. I wish, there's really no difference, like consider the Delaware in Texas or New Mexico. Nothing really changes due to the state line. We've just made up these man-made kind of fake names of just describing the 3 different areas. I wish we had not done that, because as you see here from the geology, it's the same rocks. So what we're targeting is the Woodford source rock, and there's generally an upper and a middle. So you've kind of got 2 targets there. And then you're targeting the lower Miss above that, which has a bunch of different names, but up north in the stack, it can be the Osage, the Merrimack. Osage is not quite as good, it's tighter. Down in where we're at, in the merge and the SCOOP, that Mississippian's broken up into the Sycamore that sits on top of the Woodford, and then on top of that, the Maize. So you've really got a couple of zones there. So really as an industry, we're targeting these 2 areas, the Miss and lower Miss and the Woodford, but we really got 2 zones in each. So when I think of it, we really kind of have 4 landing zones. And as we fully develop pads, we're placing our wells in those 4 different landing areas. I'm always, when I get a chance to talk to folks publicly, I try to really focus on what's core and what's not in Oklahoma, because Oklahoma's got a little bit of a bad rap. And there's been lots of companies that have gone bankrupt, but I can assure you every single one of those bankruptcies is outside of the core fairway. And really what defines the core on the left-hand map here is this is a FEH map of adding both the Woodford and the lower Miss together. And you see the red areas that really bullseye where a couple of kind of famous areas for us out here, and then the bottom down in this, that's really the core of the scoop, where you really just have some really thick Woodford. And then that red dot up there in Canadian County, red area, is also another thick Woodford area that is the Cana field. That's Cimarex here in town, and in Devon, we're really the major two developers there. So there's a lot more to defining, as we all know, what is pay and what is not pay, than just thickness of your source rock. But if you had just one thing, you kind of see where those two really highlight. And in this case, really anything that's dark green or better, so dark green into yellow or blue, is the core. And then what defines really the eastern western boundaries of the core are really the map on the right. And we have a really highly variable oil and gas content here. Really on the far right to the east in the green area is really normally pressured, very oily, low GOR. Whereas the far west in the dark red there is really dry gas. But what changes in between is all kinds of things. So we've really got an increasing pressure as you move down dip from the east to the west. So you want to go west to get more pressure, but you want to go east to get more oil generally. So trying to find the sweet spot is the key part of the play, to get enough overpressured regime, because really normal pressure about 0.45 psi per foot on the east, and really high 0.75 and above psi per foot on the west side. So you're really just trying to find the right blend. And really the most oily parts of the basin on the far east are not the most economic parts of the basin. Because you're just not getting as much hydrocarbon out of your wells at enough pressure to get high rates and high EURs. So really the best part of the play is right down the middle, as you might expect. So whether it's the stack, whether it's the scoop, or whether it's the merge, really the best wells are in the middle of all that. So that's where we've tried to see our yellow. Of course, not everybody's always in the core. We like to claim we are. We've got some acreage that clearly is not, but the vast majority of what we have is right down the fairway, and that's served us really well. And then maybe my last slide here real quick is just what's going on with the rest of the industry. Big players here include a few here in town, right? So Oventive and Cimarex would be the two big publics that play in this play with us. Oventive is running a rig because they bought Newfield out. So they've got both stack and scoop. So they've got a rig running up in the core of the stack, and really have all through last year, and then a couple rigs running down in the scoop. Devon, a big one. They kind of went away during COVID, but have come back now with a couple rigs in the stack. A couple of the big ones just at the stack too. Marathon was big there, and the scoop. They really haven't come back. It looks to be not very core for them. But also up in the stack, really, there's not a lot of overpressured, high-quality stack left. What's left is that kind of gray, almost bean-shaped oval up on the very north. And really, that's what's left of the good stuff in the stack. And we saw that a couple of years ago when we came into this play, that there wasn't a whole lot of good stuff left, quite frankly, so we didn't focus there. So one of the reasons a lot of the bigger companies have left that is, yes, they've got drilling locations left, but just for their scale and their size, not a lot. You get down to the core merge, the primary developers there are us and Citizen, so really driven more by privates. But you see the green oval there, that's Cimarex's area that they call Lone Rock, but right in the heart of it, another nice little sweet spot. So they're back as well with the rig. Then the core scoop, lots of players down there because it's a little bigger and less developed than the stack. So there's a lot more running room left to go. You've got a couple rigs, Continental's always running 2 or 3. Their area called Springboard, kind of right in the middle, and now they're expanding. That's in the light blue, and then they're expanding to the south with more kind of Springboard 2 and 3 using their vernacular. You've still got EOG with a rig. You've got Oventive down there, Gulfport down there. They're a little gassy. They're on the west side. They're going through bankruptcy due to their large debt level that they used to get into the Utica. So not really due to the quality here. They have very good quality acreage. It's just a little on the gassy side. And then the play is actually expanding way to the south as well. You kind of cross a big fault complex to get what we call the Southern Scoop Extension, which is really the Ardmore Basin. You see that kind of little ovals of us there in yellow. And then even further, almost to the Texas Red River border, you've got the Marietta Basin there that XTO/Exxon's been running a rig. So I think a really key thing, though, when you kind of look at this is where's everybody's hot spot? And that's what I've tried to put in with these ovals, their best areas, all of them right down the middle of the core fairway. So that's the scoop stack merge and just an overview. And yeah, glad I know Kat and lots of other folks in RMAG from our team know a lot about it. So please ask them all the questions in the world because they'll do a better job than me. We also run another company. We took over a company called Lux, and that's in the Delaware Basin. So quick little map here. We took over this company in 2020. Some good history in our team. We've really two teams that kind of started Camino. We've expanded way beyond that with lots of experience, but some of us from Centennial work this area. Some of us were in the Vantage team that worked the Barnett. So lots of Texas experience. Here we've got about 28,000 acres, produce about 14,000 a day. The previous team drilled about 35 wells. So we've got some good diversity and experience out here. We've now just kind of out here drilled. We're drilling our second well. We've done a couple of completed a couple of refracs and done really well. The first refrac we did, trying to take what we're doing in Oklahoma, a little bit different fluid design. That first well is a top 10 out of 300 wells in its nearby area. So you can kind of see from the map, it's hard to see all the names, but we've got two spots here. That's the Pecos River dividing Ward County from Reeves. We've got a big swath of yellow there in Ward, and then a little bit more in Reeves. Right in between the two of us, our names in Denver. PDC has got a lot of that in between our two spots, as does Centennial. So lots of history in town in this little part of the world. So managing both of those, and kind of thrilled to be busy. So with that, really kind of get into the meat of talking today and kind of weathering this storm and really all the things that are coming at us. And I think a few things that I've kind of titled setting the stage. One is just looking at our industry and what's the status of our industry post-COVID. So this first one is looking at our rig counts. So on the left axis, black is the horizontal rig count in the lower 48, whereas orange is the number of frac spreads, so frac crews out there. And I think what people forget, because 2020 was so bad, that quite frankly, 2019 for our industry was pretty poor as well. As you kind of see the number of rigs, we were dropping in 2019 from over 900 rigs down to about 700 pre-COVID. Why were we dropping rigs in 2019? And we'll see a couple more slides. We were dropping because prices, and that's the green line there, that's oil price. Oil price was kind of coming down at the time. And the other negative about that wasn't just the prices were coming down a bit, is our cost structure for our industry was more at a $70 cost structure and pricing going from 70 down to 60. So our economics were getting squeezed pre-COVID. Then COVID hits, you see everything kind of happening really quick there in April as prices, we hit the negative 37 kind of dollars famous day. And we're now kind of coming back up of that bottom. We did kind of bottom out in June, July at about 200 rigs. We're now actually approaching 400 rigs. So we've doubled from our bottom, but we're still half. Most of the industry talks about pre-COVID being 800 rigs. So today we're about 400. So we're about half. But actually prices are about where they were pre-COVID. And I'll talk a little bit more about that and really answering the question, well, if prices were the same as they were pre-COVID, why are rigs at half? Also, why are frac spreads about half as well? We're pushing 200 frac spreads now. We were doing 400. Lots of analysts predict actually that it takes about 200, maybe a little more, 220 fracs running to keep our production flat in the United States. So we'll come back to that comment because I think it's kind of important as we try to predict the future a little bit. So here we are roughly, I would conclude, we're doing about half of what we were as an industry from pre-COVID days to today, even though prices have actually come back up to about pre-COVID levels. So here is a bit more on this prices. And that's a big question today is like, we've seen this nice little run up, but is it gonna last? So let's look at oil first. That's the orange line. So you see, even go back to 2013, because I wanted to bring in, when was it 100? It seems like it was ages ago, but we were $100 oil kind of back in 2014. We have the big drop in 2015 with the Saudis putting in lots more oil on the market. We climb our way back to about $70 in early 18. And then as you can kind of see, as we talked before, 18 and 19, we were actually in a declining market. And then it really hits hard with COVID. What you see also on the green line is the forecast. And that's the future strip, basically, that we call it, that you could go hedge at. So pre-COVID, that kind of blue line, the forecast in the market was long-term about $50 oil. So here we are back up to, almost $60 oil short-term. But the strip says we're still going to come back to that longer term $50 world. So really the long-term forecast hasn't changed from pre-COVID to COVID. Short term, we've actually got ourselves back up to almost $60, which is about right where we were pre-COVID. So you look at gas, it's kind of the same thing on red. Not so good, right? We've had tough gas markets for a long time. And you kind of see there in 2018, 2019, we were about $3 and that felt great relative to where we went, but we got all down below $2. We were headed down to $2 even pre-COVID. So gas has been tougher for longer. So here we are, but if you look at the strip, similar on oil, the blue there was the strip pre-COVID, long-term about $2.50 gas. Today, the red forecast there from the strip is also long-term about $2.50 gas. Even now short-term for 2021, we're pushing $3. So very similar to oil and gas, both of them pre and post-COVID. Short-term, our prices look pretty good. Long-term, the forecast is about the same as our forecast was as an industry pre-COVID, right? So that's impacting things that we'll kind of tie that thread to a few more things. So life does look good. It looks a whole lot better than it did a year ago. But if you kind of open your window to 2 years ago, we're kind of about the same that we were kind of pre-COVID. One thing I'll hit on here is this comment about super cycle. I forgot to hit that. That's a phrase that's being thrown around right now by a few analysts. There are some, especially JP Morgan and Goldman Sachs, are predicting that don't believe this strip. We think it's going to be a lot higher, that basically by the end of this year, we're going to see $70 oil and possibly higher next year, 70s, 80s. That would be phenomenal. I wish it would be that way. That's not what the forecast is from the strip is saying in the market. But why they call that a super cycle. And really to define the super cycle is demand's going your way and supply is going your way. So when they look at the data, both of those things are pushing prices up, meaning demand's increasing quickly and supply is not increasing. So supply not necessarily going down, but not increasing. So both of the things kind of going your way, assuming you want higher oil prices. So that's kind of the definition of the super cycle. Whereas kind of COVID was just the opposite. It was negative in both ways. Demand dropped hard with COVID, and then supply went way up because the Russians and the Saudis had increased production right prior to COVID. So both things went the wrong way. This forecast, at least from a couple of banks, is that both things are going to go the right way for us, and you could have much higher. So it's interesting. And I would say probably most prognosticators think prices will be higher than what the strip is showing than lower. But we shall see if we think that's true after looking at a few more other things. Another big issue around our industry in terms of money is, quite frankly, the lack of it, that our industry is not being fed much capital for the last couple of years. And the question is why? So what this is just looking at equity performance of public oil and gas stocks versus just the market as defined by the S&P. So if you look at the orange line, that's the S&P 500. So the total market. And I go back about 10 years here so we can kind of see the advent of big shale production. So as we all know, the stock market with some serious ups and downs, though, has been nothing but up for about 10 years. The oil stocks are vastly different. That's the blue, the XOP, which is, again, adding up basically all the oil and gas stocks. It was hanging in there just like the S&P until about 2013 into 2014. And then when we saw the big crash in prices in late 2014 into 2015, all of a sudden the market's like, whoa, I'm not buying oil and gas stocks because oil's dropping like a rock. Okay, so now we get to 2015, or 2016 through 2018, and you see the blue line relatively flat. So what's happening there? That's actually when oil went from $30 to $70. How come our oil and gas stocks didn't double, just like the oil and gas prices doubled? Well, that was, if we kind of think back of shale days, that's the land rush that was going on. That was the 40,000 an acre that people were buying Permian acreage at. It's us also as an industry saying we're going to have 48 wells per section when the real answer is probably 12, right? There was all this kind of big promises about the quality of the acreage, how many wells we can drill on that acreage. And then we were drilling like mad, right? So we're increasing production big time during that period. But quite frankly, we're not making any money. We have great production growth, but we don't have profit growth. At the same time, the stock market's going really well. Then that takes us to 2018 and 2019. And that time we talked about before, we got up to $70 oil, and now the 70 is turning down into 50. So it's declining again. And yet oil and gas, or yet the regular market is going up. So you've got this wide gap that gets us to today, that over that, roughly 10-year time frame, the market's gone up 200%. We've gone down 60. So what the public market's looking at is going, why do I need to invest in oil and gas stocks when I can get tons more return out of non-oil and gas? We as an industry were at the max back in 2013, 2014, we were about 12% of the stock market valuation, oil and gas. Today we're less than 3, right? So the market has fled us. And what that means is public companies have had a hard time raising equity. Public debt, like high yield debt, they've had a hard time raising that. And then what flows kind of from publics flows to the privates. The private equity providers stopped giving as much money to our industry. So we've had this real dearth of capital into our industry over, and it's not just a few years, it's really been gathering speed for the last 3 or 4. Now, since the beginning of the year, the last really 2 months, January and February, oil and gas stocks have outperformed the market because we just got so low that we became an enticing target because, well, they can't get any lower was the theory, and it's been true. So we've had a nice little run for 2 months, outperforming the market. But literally for 10 years, we've underperformed the market. So this has led to really a lack of capital coming to our industry. So what's production? We talked a bit about production, and I think here we all know the growth in production that we've seen, and it really ties back in. You see the peak we had in 2014 before prices collapsed. Then you see the run up we've had since then. So that was going back to the previous page when I talked about kind of 2017, 2018, 2019. Production went nuts, but profitability did not. So now we're in the problem of what's next. So you see obviously the quick drop from really, we hit about 13 million a day, and today we're about 11 million a day. And the big billion-dollar, trillion-dollar question for the whole world around energy is what's U.S. shale going to do for the next year? Will we hold the line, to use a phrase that's become popular with GameStop and things like that? Will we hold the line or not? And this big pile on the left, of this production outlook uncertain, talked about less capital, free cash flow focus, which means investors are saying, I want you to make money. I don't care what your production is. I just want you to make money. And if you do make money, the first thing I want you to do is pay down your debt. Then you've got things that we'll talk about coming up, but these other things kind of outside our industry hitting us, drilling bans, increased regulatory. Can we drill another, or can we lay another big pipe to, who knows, quite frankly, because most of the big pipes now are getting, attacked. We don't want you doing that anymore. You've already, and this is not necessarily true everywhere, but the concept, you've already drilled your tier 1. Now it's time to drill tier 2. Is that economic? Where's the next new play? What's long-term demand going to be as everybody drives an electric car? Short-term demand. When is the demand from COVID coming back? Just this volatility. It's hard to invest in our industry when you have a lot of volatility. In my mind, every one of those lists that on that side says, actually, we're not going to grow production that much. And most people are predicting for 2021 that we're going to be flat to 2020. So we're going to average about 11.2 million a day and stay flat. That is why prices have gone up for the last couple of months, because people are seeing this discipline by the public companies saying, despite higher oil prices, I'm not going to throw more rigs out there. I am going to do what you're asking me to do, which is pay down debt and give you money back as a dividend. So right now, the market anticipates discipline. And us keeping this kind of 11 to 11.3 million a day. If all of a sudden in 6 months from now we're doubling rigs, which I don't think we would, but if we were, we're going to be pushing 12 million a day. The market's going to freak out, quite frankly, and prices will drop, and stock prices will drop as well. So say all those reasons why we wouldn't, but what's happened every single time if oil prices increase? We just drill, right? So that's the worry: is could all of those kind of things that imply growth will not happen, will they be offset by just the fact we make higher price, we're making better, we're getting better prices, and quite frankly, our cost structure is reduced. We collectively, as Camino and most of the industry, would say that our cost structure, the cost to drill a well completed, is down about 25% from pre-COVID kind of days. And now they've started to come back up. I'd argue we've added back now in the last couple of months about a 5% inflation, higher number, but we're still good down 20 to 25%. So we have this lower cost structure back on higher prices. So we should be making a good bit of money here in 2021. And the market's just asking us to please don't put that back into the ground, keep a moderate rig pace, and and pay down your debt. But that's the big question. Where's the 11 million in the United States going to go? Up or flat? So that's kind of setting the stage of all these big macro themes about how we got here. Now what's next? And to me is we just can't not talk about all the things that are happening out there, right? This energy transition and ESG. To me, those are two very different things. We'll talk a little bit about energy transition. To me is, going to the hydrogen economy, right? Or environment, EV vehicles, whereas ESG is environment, social, and governance. And that's different. It's more focused in my mind on the environment side of that. It's what's been getting the most press, which is, greenhouse gas emissions, methane. All right. So they're related to energy transition, because the goal under energy transition is to reduce pollution, but it's more high kind of big picture. Whereas I look at ESG as a little more micro versus the energy transition macro. But we're seeing all kinds of things right now on interstate pipelines. We've already talked about the DAPL pipeline out of the Bakken. Keystone, every new gas pipeline that we've tried to get out of Pennsylvania to get to the Northeast has been stopped. So that's happening. Many, the fracking bans, so far, obviously fracking bans haven't hit a Texas or an Oklahoma. When they do it in Vermont, we really don't care, but that trend is happening. You see General Motors, 2035, it's all going to be no more ICE engines, meaning internal combustions. It's going to be EV. Volvo said that yesterday by 2030. I think read between the lines there. A lot of those things also include hybrid. They're not just necessarily 100% EV, though that's what the headlines say. They're usually EV plus hybrid. Carbon neutral. Lots of cities, states, nations. We're going to be carbon neutral by 2050. Right now, clearly, we have a 60-day ban or pause on federal leasing and permits. Will that be permanent? So I see this as a massive rock slide coming our way, right? It's already happening, and it's going to continue to happen and become a bigger and faster as opposed to slowing down. Coming to a city near you. Maybe many of you didn't know, like I didn't know until a while ago, the city of Denver actually has an Office of Climate Action, Sustainability, and Resilience. And it just came out with a report a couple of weeks ago. And some quotes from it. The goal will be all new buildings are achieving net zero energy by 2030, not too far away. All new buildings and homes should be free from natural gas. It recommends that in the 2024 building code that no natural gas, you can't hook up your new home with natural gas. And that's amazing to me. And, this has been happening. Berkeley, San Jose, last thing I read, there's 50 cities who ban natural gas hookups. Well, me and many others, you can go, well, that's California, and it's just California. The weather's great there. They really don't need it that much. What's the big deal? It's really been a West Coast thing. Well, now here we have the city we live in effectively doing the exact same thing. It's not happened yet, but this recommendation is coming. It's all out there public. You can read this as I've skimmed through it, but they've got to go through two more steps, one before the city task force on building codes, and then on to our city council. But my personal prediction is going to pass. So interesting, right? That these movements are not just isolated to, what we would consider Gulf Coast, or sorry, not Gulf Coast, West Coast type of things. So let's talk about another thing that's hitting us, right? The big storm of last week. And I think there's, depending on the political spectrum, it was either renewables' fault that Texas especially didn't get the power they needed, or it was us, in sense the fossil fuel industry. And of course, the answer is never that obvious on either side. So I want to put some real data out there to take a look at this. The graph on the left is ERCOT. So really the Texas power grid, which is isolated. It is not connected to the rest of the country, which is the uniqueness to part of the problem they have. But if you look on the left, it normally is doing about 40,000 megawatts a day of needed power capacity. And on the bottom there is nuclear. So there's a little bit of nuclear. Coal is in gray. Green is wind. Yellow is solar. And red is natural gas. So you kind of see, pre-storm, a normal winter, and they use about 40,000 megawatts. and you see green, which is wind. And when I eyeball the green and the red, it's kind of about the same. So when I look at Texas has a ton of electricity coming from wind. Actually, in Oklahoma, which this isn't about Oklahoma, last year, 50% of the electricity created in Oklahoma was wind. Makes sense. It's windy as all get out in Oklahoma, as it is in North and West Texas. So I think the important thing in here is that wind is a big and important part of the mix in Texas. Really similar volumes on any given day to natural gas, but it's highly variable. And you see that with the green going up and down. And what fills the gap when it's not blowing? It's natural gas. And I think shock absorber is a word I saw by Ryan Zorn. Maybe many of you guys know him here in town, but he did a nice little write-up on it. So I'm stealing his term because I think it's perfect. It's the shock absorber. We turn it on when we need it, and we turn it off when we don't. And so that's kind of just to get a feel. So what happens during the storm? Obviously, wind goes down and gas goes up. So as we should and as we do, we turn up the gas volume. And we did, and we turned it up and up and up until we hit to about just over 65,000 megahertz. And then it was really cold and lots of things started freezing. And therefore, both at the wellhead and at the natural gas plants, we didn't all go down, but we definitely couldn't deliver more. So hence, lack of supply, lack of power gets turned off. But if you kind of look there the last few days of the storm, it's still natural gas providing the bulk of it. And we still ramped it up from what we would normally do, and wind wasn't. So this isn't an anti-wind story at all. It's to say both of them had major impacts, but the reality is without natural gas still saves the day, or it would have been a lot worse. Now we'll go to the bottom part of that. The graph on the right is the same data, but just a percent to kind of prove it out. So you see the green on wind. On any given day, on a fine, normal, sunny winter day in Texas, it can sometimes provide 59% of the energy needs, electricity needs, but one day it's 1%, right? So it's just that super variable. But it did average about 29% kind of the week up before the storm. But during the storm, it averaged 8%. So I think that's, so I get a little cheesed when I see, the extreme environmentalists say the gas didn't deliver. That's just not true. Wind did what we expect it to do, which is go down on tough times, and we're there to fill the gap, but we couldn't fill the gap as much as it needed to be filled. So bottom line is all forms of energy had significant downtimes. And this really goes into, I think when we're looking longer term, we're going to have far more wind and solar and renewables in this country, and that's great. But we're going to require still the backup, so to speak, to come from fossil fuels, and not just backup, but it's a base load, and then it's the backup to kind of fill the gap when needed. But it took a long time to explain that here, right? And you can't explain that in a USA Today 30-second blip. Now let's look a little bit more to the future. The world's demanding far more energy, but it sounds like they don't need fossil fuels. If you look on the one on the left, that's just a prediction of the GDP, the gross domestic product of the United States. As long as we're growing, that's great, right? So it is growing, and it's expected to continue to grow in the United States. Well, to grow GDP, you need energy. A more developed country like us uses less energy per unit of GDP. So you kind of see now, you see a much steeper increase in GDP. You see a much more kind of, small increase in the need of energy in the US. If I was giving you for India or a more developing country, even China for that matter, their energy consumption is going to be going, much more up to the right than we are in a more developed country. But I think a key thing today of the energy consumption in the United States and generally worldwide is 80% from fossil fuels. That this isn't just electricity, this is transportation electricity, every form of energy that's required. Of that 80%, 55% of that is coming from oil and natural gas, and 25 from coal. So this kind of some predictions that this is the beginning of the end of fossil fuels is just not credible in my mind, because you don't take 80% of the world's energy comes from and turn it off tomorrow and replace it with where the other 20% comes from. It just can't happen. And that, even including that other 20, is nuclear, right? So this is a long transition, is my point, that there's just, we don't have the technology and to change overnight, and nor the infrastructure and all kinds of things that come to that. So I think that's why I take some solace that our industry is going to be needed for a long, long time. Just a little quote there on the bottom. Another reason why energy is just going to go upward need for time is today, actually it was 2019 data where I read this, is like mining Bitcoin in 2019 is equal to the energy draw basically in the entire country of New Zealand. So it's not the world's biggest, obviously. The third largest country or energy user in the world is Japan and its economy. Bitcoin today is averaging the equivalent of about 13% of the energy needs of Japan. So it's big. So if you think Bitcoin's going to explode, which a lot of people do, energy needs are going to explode. So how do we solve all that is the difficult question. Well, what are we doing about it in our industry? We try to bring this a little bit home. You've got the big companies and you got the small companies. So I kind of looked here at the big majors, and you can really divide majors between European-based ones and US ones. So the Europeans, BP, Shell, Total, I would argue they are far and away moving further and faster. And I'm not saying that's right or wrong. It's just a definite European outlook along this is to move to this transition quicker. So if I highlighted that, I would say they are in the energy transition. And by that, I mean, how do you prove that? Well, BP stated that they're going to drop their oil production over the next 10 years, as has Shell. So they're basically saying they've peaked as a company producing oil and gas by choice. It's not that they don't have it. It's not that they don't have the inventory. Not that they could do it. They just choose not to. Total, a little bit different. They're going to grow still a little bit, but they have actually changed their name. It's no longer just Total. It's Total Energies. And really what these three companies are doing, especially more in Europe first, is they're kind of taking it what I feel is kind of like downstream. A lot of them are selling energy to us as consumers, right? So they're going to try to sell electricity. They're going to try to sell hydrogen, things like that to the consumer. So it's just interesting to me to see what they're moving it fast. So what are our two majors, Exxon and Chevron? They haven't gone as far. So I would describe them as kind of in the decarbonization mode and more focused on ESG. And I see that by like both Exxon and Shell have both really reduced their CapEx by about $5 billion a year in the upstream space than they were going to do. And that's one of the reasons why production in the United States should not increase like it has in the past. A perfect example is Exxon. They were running 57 rigs in the Permian pre-COVID. They're running 8 today. Chevron was running 19. They're running 5. So those are decisions that take a long time to change for companies that size. So I don't think they're going to change and all of a sudden go back, 8 to Exxon going to go 8 to 30, anything like that. So that's going to temper production growth coming out of the Permian. Both of them had projections they would each be producing 1 million a day in the Permian within 3 or 4 years. That now those projections are more like 700,000 to 500,000 each. So they're really bringing that, dialing it back. So they're addressing it by significantly less oil and gas spend, but also a lot of decarbonization, which to me can mean like carbon sequestration. And Exxon actually they did their analyst day yesterday. There's a very nice big packet in there. It's worth reading. The first 10 or 15 pages talks a lot about the need for oil and gas still. So they've taken a little more conservative approach to the energy transition, but still highly focused on environment, social governance, things like that. So a little bit different. What do we do about it? And by we, I think of me. I think of private companies. I think of smaller public companies. What do we do with our company to address this? Because we do have to do something. We can't just, we're along for the ride. Whatever happens, happens. And we're just a taker of what happens. Well, we do get kind of moved along in the big stream of energy transition that we're not going to change, quite frankly. And I think that's the first thing that I come to is acknowledge it, right? That we're accelerating the decarbonization, the energy transition in the world. And this massive movement is happening. It's going to go faster and it's going to go quicker. And they can do it through lack of capital, like I already talked about, regulatory framework, which is happening, making things more difficult. So there's lots of ways that society, whether it's political, whether it's financial, can kind of put the governor on us and slow down our industry. And quite frankly, my point is it's going to happen, and get with the game, and you can't fight it. So we need to roll with it and adjust to it. And one way, there's a lot of ways to do that. We just got to keep repeating the facts is one of them. We are the safest, most environmentally best place for oil and natural gas. We have the strictest regulatory environment, only going to get stricter. And we're part of this transition. Natural gas clearly is part of that transition. Even now, on the extreme cases, we've seen where cities are trying to stop natural gas hookups, but that's going to still be small, I think, in the big picture of things. But we've got to continue to show how important natural gas is to the transition. But we have to earn our social license, right? And by that, it's our right to exist, really. And therefore, that really brings us into ESG and the leadership that we even need to show as private and smaller companies. So I feel we need to support this kind of all of the above strategy. We're not anti-wind, we're not anti-solar. We need it all. We need a lot more energy, and we'll figure it, in my mind, the incredible technical advances as a human race that we continue to do every single time, and we'll do it again. But I think we as individuals need to think hard, right? And we need to keep networking and doing things like RMAG and everything you can, because our industry it's in a big seismic shift, and it's a little shaky. It doesn't mean it's shaky that necessarily that we're going to come out bad, because I don't believe that, but it's moving, right? And you need to be as connected as you can be in your technical community and in your neighborhood in all the ways you can. To talk positive about our industry as well. But just to keep watching and paying attention and investigating where this is all headed. So when it really comes down to it, on the ESG leadership, well, what does that mean? What do we do in our own companies? And we're in the middle of doing this right now at Camino. We already had things in place, but we're really upping our game, and we're in the middle of figuring all that out before we roll it out. But you've got to plan it. You got to engage the whole organization and showing its importance, and then you got to measure it all. And then when we measure it, we got to go improve it and report it. So even you could say, well, what does a private company need to report, outside our own company, what our ESG kind of goals and performances is? Well, first of all, our private equity provider who gives us money is getting those requests from their limited partners that invest in them. And if they can't show to their investors that their companies are on the leading edge on that, they're not going to get money, and therefore we're not going to get money. So you don't have a choice in that sense. You have to do it. But I don't see it as negative. I think this is a great opportunity to really set the stage and show what our industry can do. And it's collectively, we need to do it all together. So what does that mean? Again, kind of, because I keep thinking this, well, what does this really mean day to day? On the environment side, GHG is greenhouse gas emissions. We need to report those. At some scale, if you're small enough, you don't have to report those. But we've now reached a scale where we have to. So we're going to do that. We're right now kind of in backwards looking at kind of exactly what were our emissions in 2019 and 2020. And once we have that baseline, we'll be able to figure out how to get better. What a lot of companies do is LDAR, which is leak detection and repair. You're required on new horizontal wells since 2015. You actually go out to every well twice a year and use the infrared camera to look for methane leaks and then fix them immediately. So you do that. And a question I have is, should we be doing that more? The law says we do it twice a year. Should we be doing it quarterly? Costs you money. But also, should we just go a step above? So we're debating that. Flaring is something we can control, and methane is more impactful to heating than CO2. So our industry just needs to cut flaring, what they're calling normal flaring, routine flaring, to zero. And we can, and Colorado's kind of leading the way on that. But everyone's talking about this, and so I think our industry is all on board for getting routine flaring to zero, and that's something we can touch a little easier than CO2, and that we can impact a little easier, right? So we're all working on that. You need to pipe everything you can. Get your oil, your natural gas, your water on pipe as fast as you can. Less trucks on the road, less emissions. Safety as well. Recycle where you can. So there are ways we can do that, and we're doing it as an industry. We just have to pick up the pace. The social side, kind of what's the difference? So our traditional HS&E, which is health, safety, and environment groups, are now morphing into more of an ESG group. But that's kind of where our traditional HSE was, and that was safety in the field was the primary bit of that. Also, emergency response planning and working with your local first responders to make sure you've tested things in case something does go wrong. More community outreach, monitoring your diversity and having more diversity in every which way you can describe diversity. That's the social side. Governance is more about making sure that we have the systems in place to make all this happen in the right way. So company-wide performance goals, about targets, having ESG performance, GHG and flaring as a part of your bonus. and just making sure there's alignment. Cybersecurity is new. That kind of fits under governance. COVID-19 is new, right? So getting into the weeds can kind of bore people, but this is part of my job, is to make sure really every one of these bullet points that we have a plan, and that we're measuring it and reporting it and getting everybody on board. So with that, I'll finish up here. Kind of get a little bit of kind of went off into the macro and kind of what's hitting our market, our world today, and kind of how to deal with that. This is kind of a last page on Camino and more of a business plan, so to speak, in bullet points. And I think strategically, and I think this really fits to all companies of our size today, no one cares how much acreage you have. They care about the quality of the acreage and the returns that you can get. So we have to prove rates of return, not just acreage. And that seems obvious today. That wasn't true even 4 or 5 years ago. If you could just show how much Permian acreage you have, therefore it must be good, right? That's just not the case anymore. You need to prove the return. You need to be bigger rather than smaller. It just makes you more efficient. You can handle all these things that we need to do and be able to afford it, quite frankly. Cash flows first, production second. Just the opposite of what it used to be. Everybody wanted production growth. Now it's just show me your economics are better, and you're returning money back to either your debt holder or your equity holders. Financially, hedge a lot. The volatilities, I think during all this is only going to go up. We're going to have higher prices. I have no doubt 4 or 5 years from now, the prices are better than they're going to be today. But that doesn't mean it's a straight line. It's going to go up and down. So you need to be hedged. You need to keep your debt low. Mentioned on free cash flow. And I think operationally, as we're moving into a more developed shale era that we're in, we're still clearly not remotely towards the end, but we're not at the beginning anymore. So now it's all about doing it efficiently. So it's economies of scale, getting bigger partnerships with your service companies. It's about pads. How do you best develop those 10 wells on a pad as opposed to per DSU, as opposed to the belief that it was 40 before. And we talked about ESG. So that to me is how I kind of bring these more nebulous macro things down to a micro situation for our particular company. Last slide, always got to put a plug into Oklahoma. Oklahoma's great. It's more than okay. So with that, I've probably gone over my time, but I appreciate your time, and I'm happy to field any questions. And I'll stop sharing here.
Ward, that was great. Thank you. That was a really awesome presentation. I think I was definitely floored with all the technical information. That was awesome.
You can't take the engineer out of me, ultimately.
Yeah. We're at 1:05, and I have one question here. Are some of these European ESG-driven drops in production more of a financial action in an effort to champion cash flow over production growth and retain investors? Or are they serving both sides?
I think they're more of the latter, meaning trying to give investors what investors are asking for. Yeah, it's kind of holding back more for that reason as opposed to an ESG reason. For sure, I'm quite confident of
that. Everybody's thanking you for a great presentation and overview. I think you really hit the ball out of the park there.
Well, I appreciate it. Like I said, you can take any one of those slides and talk an hour on them. So I know I kind of went over, but it's complicated, right? We're on one hand, we're in this incredibly important industry, yet at the same time, it's just changing big time. I think any more changes right now than my entire career. So
there's still a follow-up question. What are your primary takeaways from the big freeze in Texas recently regarding natural gas production in markets?
I think what's interesting about Texas is because some of the comeback has been, well, natural gas flows just fine in Alberta, all the time in much colder weather. So why do you guys have the problem? Well, they have the problem in Texas, and we had it in Oklahoma, but not near as bad. But right, you just don't winterize things as much. And why do you not? Because it costs you money, right? And do you prepare for the once in a 10-year or once in 20-year storm, or do you not? And quite frankly, if it's going to be once in 20, you don't. That's the reality of business, right? So I honestly don't think a whole lot's going to change in Texas in specific, because it just kind of costs too much to winterize the entire power grid, so to speak, from the wellhead, to the power plant. So I think it'll be really interesting. There'll be a lot of, jumping up and down and talking, but the net result is who's going to pay for that. So I don't think a whole lot changes, on all honesty, from that. And we've learned things every time, and how to keep wells running longer and faster. But in terms of spending all that extra capital to winterize,
it's such a rare event.
Yeah, it's not going to happen.
You get more hurricanes and stuff in that state than you do freezes.
Exactly. That's exactly right.
What's your thoughts about like nuclear electricity? Is that going to have more of a role going forward? I mean, that seems to kind of fit a lot of the ESG roles. It's just kind of a demonized power source.
I'm convinced that we're still, that with rare exceptions, that the existing plants are not going to be idled, or taken away like they have been in Germany and places like that. But they we're not going to see new nuclear power plants. So I think it's the status quo, quite frankly. So give or take, nuclear provides about 20% of the United States electricity today. I think that it stays at that number or slightly goes down as new ones are not built. And I've seen a few big utilities I've read in the last couple of weeks have just mentioned that, as they see this big pressure coming to them to use less nuclear, they've actually stepped up and kind of said, no, nuclear is part of the solution. We're going to apply for the permits to keep our existing plants online. But they very clearly choose their words very, very nicely, so to speak. And they're not saying they're asking for more. They just want to keep the current ones in. So honestly, I don't think it grows, but I don't think it goes down either.
Do you have time for a couple more questions? We've got a couple more here.
Yeah, sure. Absolutely. Yep.
You compared the Western majors, Europe versus America. What about national oil companies in the outlook of the industry outside of Europe and North America?
That's a great question. It's a little harder because on one hand, I'll argue like Middle Eastern national oil companies, especially, right, that I would argue that they're loving what's happening in our country because it means less oil here possibly, and therefore they get to fill the gap. So I don't see them changing really dramatically, but the flip side is you do see that, and they're listening. The national oil company, they're listening to the world's requests, and you see more natural gas planned out of Qatar and Saudis, and you see I think you see some acquiescence, so to speak, to the world's demands of what they want out of the energy industry, but I don't see it, remotely happening like we see in Europe, even the United States. So a little bit, but not a lot, would be my opinion of the impacts of that.
What about your thoughts about hydrogen as another energy source? Do you think that's going to come to fruition or replace natural gas?
That's a big one on my to-do list that I haven't had time to get to have an opinion. I get the concept. I don't appreciate the practical reality of it. So I've collected a whole bunch of papers to read that I just haven't done. So I'm going to beg off on that one a little bit. I see the potential for sure. And I actually see that as we as our industry think, if I was 20 years old in this industry, so to speak, could someday I be a hydrogen geologist, so to speak, or engineer? Yes, possibly. Right. So it's worth us learning about that. And like I say, I'm behind the times a little bit, but need to get up to speed.
Another question, you had an allusion to Bitcoin. What do you think about co-production with oil companies using gas to power crypto mining?
Yeah. I think it's real, and we will start having more of that. There's a couple of companies, Crusoe in Denver is doing that on specific pads up in the Bakken mainly. Where they're taking natural gas straight off the wellhead and running computers right there on the pad and mining Bitcoin. So it's happening. And I think more of it's going to happen, but I don't think it happens at scale, because still the reason it's working today like that in those small situations is because there's no outlet for the gas. And if it's, one, I don't want to flare it. So this is great. I don't have to flare it. I can go into this. But if I can sell it and I can get $3 an M, I'm going to sell it, right? That's still worth more to me as the producer than to kind of give it to somebody else to mine Bitcoin. So I think that goes, there will be more of it, but they're just very kind of specific, unique situations where it fits. But I think it's a growing industry, and I'm very intrigued by it. I think it's a great solution for our industry. It's just going to be in more stranded type situations, and generally colder weather. Quite frankly, you're seeing that more in the north and the south because it burns. It just creates a lot of heat running that many computers in the trailer. So as I've talked to a couple of people who are the experts in that, and it's not me, but I asked, well, how come you not do it in stranded Texas? And it's like, it's too hot. So that's interesting to me. I didn't appreciate that.
And then one last question here from Debbie. She's a real foodie. And she's wondering if you think the new building regulations on gas appliances in homes will apply to the restaurant industry.
And the answer is yes. And lo and behold, what is interesting in California, so the California Restaurant Association is suing the state of California and cities, for not allowing this. So they are literally suing these cities. Will they win? I don't know. Clearly, I hope they will win. But you bring up a great point that the restaurateurs are anti this problem, and maybe that will win it in the end for us, right? We need non-oil and gas industries on the same side as us, and the restaurants are on the same side as us on this. So it was great when I've seen that. So little by little.
Well, Ward, you're a wealth of information. We really enjoyed your talk. There's a lot of really positive comments coming over on the thread, and appreciate your time and want to be respectful of your time and let you hit the slopes here. And